QuickBooks Pro Plus Desktop 2022 OneNote presentation, bank reconciliation, month number 2 reports. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022 2000 double deuce. If you have access to OneNote, would like to follow along, icon left-hand side, topic introductions, 9160, bank reconciliation, month number 2 reports tab. Also take a look at the immersive reader tool, topic introductions in the text area 2 with the same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. The topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're now going to be looking at the bank reconciliation report. We went through the bank reconciliation process for month number 2 in previous presentations. Now we're going to finish it by clicking that blue button that we didn't do last time. And so we're going to be tying out what's on the balance sheet as of the cutoff date of the bank statement date and what is on the bank statement, reconciling the two not being the same due to, at this point, simply the outstanding items, outstanding checks and deposits, the timing differences, that is. So if we go to the banking dropdown, we go to the bank reconciliation. We're at 2/28, the date of the bank statement. The beginning balance rolls forward beautifully after that first bank reconciliation. The ending balance is what we have populated in place, tying out to the bank statement. We then went through the reconciliation process, this not being the bank reconciliation itself. This is the process of reconciling. And the items that have not been checked off represent items that are on our books that are not on the bank statement. We expect they probably will clear the bank statement, and we can check to see if they have by checking the bank transactions after the month of reconciliation. If they do, then they're just going to be those outstanding items, the bank reconciling items for us. We do want this to be at 0 at the bottom before hitting this blue button for the reconcile now. You can't force it to reconcile, but it will enter a journal entry if you do that to adjust for the difference, and that could cause a problem because you're not getting the assurance that you otherwise would have. The point of the bank reconciliation is not just to make sure that the ending balance is correct in the cash account, but to see that the activity is correct. And if anything is off here, even if it's off by a little bit, it could be because you have multiple deposits that are not correct, not tied out properly, and multiple checks, and the two are netting out to have a small difference. So that may not be a big deal for the ending balance in the checking account, but the deposits and the check activity, other side of them in the double entry accounting system, are impacting the other flows within your accounting system. So you want to make sure that the checking account is correct, not just so the ending balance is correct. You're verifying the activity in the checking account, which is interplaying because cash is the lifeblood of the company with all the other cycles, vendor cycle, customer cycle, sales cycle, employee cycle, and so on. So you really want that to be at 0, and it should be able to do that because all you're doing is ticking off exactly what's on the bank statement to your books. And if something is wrong in your books, then we're just fixing it to tie out to the bank statement in general, unless we think the bank statement is wrong, which is not typically the case. So we went through, we ticked everything off here, everything ties out. And so what we did is we said the beginning balance tied out, the additions tied out, the subtractions tied out, and that's why we have that 0 balance. When we hit that blue button, we got 2 reports, a summary report and a detailed report. The summary report is a cleaner looking report, but it doesn't give us everything that we need. Remember that it does give us that stuff up top, which isn't really exactly what we need. But what we're looking at is the heart of the statement, which is going to be in the middle here. So the top part is going to give us the beginning balance, the increases, the decreases. These are the cleared items, which will basically just tie out to what's on the bank statement. Then we'll have the cleared balance, which you can think of as the bank balance because it matches our cleared balance, all the stuff that we checked off, but that's really the bank balance. And then we're going to have this stuff that didn't clear, outstanding checks and deposits. These are the reconciling items. This is the heart of the statement. And then we're going to have our register balance. This is the amount that's on our books. So if you were to give this to an auditor, this is the heart of what they're looking for. They're trying to say, okay, what is the reconciling items, the exact differences between what is on the books and the bank statement, these are going to be those items. Now, this, however, will not please an auditor, given the fact that they don't give us the detail of these items. They just say there's 7 items here. Well, that's great, but I'd like to know what those 7 items are, verify if they're legitimate items, see if they cleared the bank statement in the following period. So what you're going to need then to check that is going to be the detailed or the reconciliation detail report, which gives the breakout of what those 7 items and those 2 deposit items are, so that you can then verify that these are legitimate items. And they're legitimate items. Generally, the easiest way to verify is to see if they cleared the bank after the cutoff date in the following months. And if they did, then it's just a timing difference, and we've reconciled exactly what the timing differences are, and all they are timing differences, if that was true, between our books and the bank's books, giving us an external verification not only about these balances, not only about the bank balance in total, but about all the activity that has been entered into the system, activity which is impacting not just the checking account, but due to the double entry accounting system, all other accounts in the accounting system, all other cycles at least in the accounting system. That's what gives us that verification. That's why the internal control is going to be so important. We expect then these items to basically clear in the following month as well. Now, if you were to construct this just to think about how this would happen, like what is the system actually doing, notice again, if you just took the general ledger account, this is the general ledger account for the first month. Remember, we took the bank reconciliation for the first month, just taking the GL, and said that these items are the ones that didn't clear. These ones that didn't clear are the things that were used in order to create our bank reconciliation for the first month here. So we had a bank reconciliation for the first month. Then on the second month, what happens when we do our bank reconciliation? It's the same process, but it's a little bit more confusing in that when we look at the general ledger account, we got the general ledger account here, plus the uncleared items from last time, because what we're comparing when you look at that beginning cleared balance in QuickBooks is the balance that you checked off, not exactly what we have in the system. So that means that we've got these uncleared items from last time that we're going to have to check off. So we would expect then, if we go through the process of reconciling, this would be similar to QuickBooks, we're going to be checking off the stuff that cleared last time, right? They were on the last uncleared items, so we wrote them in January, and then all the stuff that we wrote in February, the stuff that we included in our books, increases and decreases to the checking account in February, will also be checked off. And then we're left with the outstanding items, which are these blue ones that weren't checked off here, that are going to be the reconciling items. And notice we still have one that was still not cleared, that was an outstanding item from January that also didn't clear in February. And those are going to be the things that we use to create our bank reconciliation. And again, remember, when you do a bank reconciliation in like a book problem, you typically have the book side and then, the bank side. But what we're doing here is we're fixing the book side because we're entering the data into the system. So there was a difference between the withdrawals and the service charges. But if the bank is correct, we're just going to fix we're going to enter that into our system. That means we're left with really this as the bank reconciliation after we make the adjusting entries. And so if you want more detail on kind of looking at this in terms of like an Excel type of problem, we have some courses on that. It might be a little bit more transparent to get a better grasp of what the bank's reconciliation is actually doing, so you can explain, the necessity of it, and to say a client, and possibly know exactly what, an auditor would be looking for something